So we've talked about structure, we've talked about the high and the low of the day, and we've talked about timings. The next thing we're going to talk about are round numbers. Now, the main focus of all of this is the basic general big picture. Of course, there are variations for everything, but for me, again, I talked about the high and the low of the day and timings being critical, but the next most important thing that I'm always looking at are the round numbers. Typically, most of these instruments will trade in 50 pip boxes and potentially over the course of the week in 00 boxes. And if you think about just things in simple logic terms, if there's an average daily range and an average weekly range, typically they will be working from the numbers. Often the quarter levels will be extended stop hunt ranges for 25 pips or below a box for 25 pips. If they're working around a round number, around a 50 or a 00 in that Asian session. So we talked about if the Asia high-low is around a 50 or a 00, chances are that at some point they will work underneath of that on a breakout pullback for a trade off of 50 down to the next 00 or vice versa. If it's a 00, we may get a similar situation where the market may work it and then right at the timings again, break out, pull back and come off the zeros for a trend day. But typically these markets come off of the numbers. The other thing to identify, and we'll look at some specific examples again, is that if we're at a round number, we may get trades that build up underneath the quarter level, taking traders short before reversing, trapping all this volume in that lower quarter before breaking out of the 50 for a measured move of maybe 50, 100, or 150 pips if the market is moving in 50 pip increments. So we talked about 3 levels of rise, 3 levels of fall. The markets may be trading in 25 pip increments, so they may trap volume in a 25 pip box for a 50 pip target, 3 levels of rise, 25, 25, and 25. Or over the course of a week, we may see that market compress down for a 50 pip movement and then another 50 pip movement and another 50 pip movement over the course of London and New York for a 150 pip day. We'll often see that after 3 compressive days down or up into a high or low of the week. So really important. Let's look at some examples of how these markets trade off of those round numbers now.
Good day, traders. Stacey Burke from Stacey Burke Trading. Today we're continuing our discussion of our 50 pips a day simple system, and today we're covering the numbers module. Whatever instrument you're trading, typically the pound crosses are what I follow amongst gold, the euro, a few of the other pairs, but it doesn't matter. I'm always looking for the pattern, the structure, at the timings, and then I'm looking at the round numbers. Now I talk about 50s and 00s mainly being my focus, trying to identify the 50 pip box potentially for that session based on how the market sets up. Today we'll go through and just discuss some of the variations of those setups and how sometimes they'll use the quarter extension as a area to trap volume or for an extended stop hunt. But it also gives us reference points, or gives me a reference point to position myself in terms of 50 pip movements, and then also controlling my risk, knowing that if I'm entering in at numbers at the specific time based on the setup at the higher, near the high or near the low of the day, I'm targeting that 50 pip movement. And if I'm wrong, that market should not come back into my quarter range where I'm positioned. So therefore my stop should never be more than 1/4 away from that level that I'm getting filled at. Now occasionally, depending on the spread and the pair and where my fill is, if my fill is at or away from the numbers slightly, then obviously I'm targeting, my stop would be the extreme. So potentially maybe pound New Zealand, pound Aussie, that spread with 4 pips, and sometimes it varies. if their volatility changes, but obviously 25 to 30 pips would be the maximum, and there's a reason for that, because if this trade was wrong and it was to fail, that means that I could potentially be caught in more than a 25 pip loss. So it's important to understand the numbers and study the numbers based on the timings and the highs and the lows, because that's what allows you to have a stronger thesis in terms of positioning yourself for a reversal or a trend trade, and then also looking at how the market is trading. Is it trading in 25 pip increments, 50 pip boxes, or in some cases 100 pip increments, which we'll look at. So if we just look at the pound, for example, just randomly going back and looking at a day, we can obviously we'll find the Monday here and just start our week fresh. So if we go back to a Monday, we can see that the market from Friday's high, we're just going to talk about numbers, but Friday's high was in that upper 00 box underneath 3150. The market on the Monday traded underneath of the 00s during Asia. It traded around the numbers. And we've talked about when a market trades around numbers that at some point it may layer into the numbers. So obviously if the median price in this particular case of Asia is the 00s, as that range expansion occurs throughout the day, we then on a Monday, this particular Monday, we find ourselves trading around the 00s as the range expands back and forth in a trading range type day. But eventually the market layers on top of the 00s. Now, coming back to looking at the Friday's high, again, just understanding I'm looking at 50 pip boxes. The volume underneath of this 00 area then potentially is trapped. This could be a zero type 0 day, a narrow range day at the beginning of our week. We have a Friday anchor point. The market in Asia breaks through to the upper quarter. So then, therefore, we're in this upper 50 pip box now. We're in a 00 box, but we're in the upper portion of this 50 pip box, meaning that now we've come from underneath the 00s and we're on top of the 00s. So at a minimum, I'm looking for this market, if it breaks, to go to 50. Now obviously this market broke through 50 in London, the Europe-London Open. So then my next thesis is that this market will then continue to move in a trend style fashion to the upper portion of the 00 box. So again, we started the week where the market traded sideways at the 00s. When it pulls away, we can look at this lower quarter now as trapped volume. They've trapped volume underneath of the 00s. The anchor point high from Friday is up towards 50. If the market was to break through that, then we'd be targeting the upper 50 pip box, which takes us up towards the 00s. But again, now we're looking at a market that's moving in possibly 50 pip increments. The first break level of the Monday's high on the Tuesday has broken into the upper 50 pip box. So we've cleared 50. So now we're thinking 50 pip movements. So potentially 3 levels of rise if this is a strongly trending day, which obviously it became a strongly trending day. So the market moved in 3 levels of rise of 50 pip movements, 50, 50, and 50, where we then proceeded towards the upper portion of that 150 pip movement to 3250. And a similar scenario develops where we trade sideways at the numbers. So again, median price is our 50 level. So then our thesis is that at some point the market will layer on top of 50 to continue, or layer underneath of 50 to reverse. And again, that quarter level above the 50, in this particular case, we'll just change that, became trap volume. So again, buyers above the 50, this market is trapping volume, and obviously because we moved in 50 pip increments, this whole block above 25 could eventually become trap volume. So again, we have a significant round number. So if this round number becomes a level for selling or buying, then we're targeting the next 50 pip box. Obviously, Asia, high-low. Again, if one of our sessions puts a high or low of the day in place, and we're targeting a minimum of 50 pips, because this box is 25 pips, once we break that, we're potentially targeting the next 50 pip box, because a range expansion of that 25 pip box puts us at a 75 pip target. If we're in a 75 pip target, then we're targeting obviously the lower portion of this 00 box. And again, we've got an example here of a market that's gone 3 levels of rise, gone into consolidation, worked the top, and worked the top a third time before reversing, pulling back in our 12 candle window US session off the quarter level, and then continuing its move for 3 levels of drop, 50 pips, 50 pips, and 50 pips. This quarter retracement is the stop hunt into the downward trend. So we've had a geometrical structure. We've broken out of that. The market has made a 25 pip stop hunt back against the breakout. So some traders are trying to counter trend this, and they're going long. We've got a breakout of the structure for 50 pips, a 25 pip pullback, which is a 50% retracement, and then the continuation through that range for a measured move of 50 and 50. Market again trades sideways around the 00s before dragging that market 25 pips below the Asian range and working the low of the day, but more importantly, understanding that we're 25 pips below the 00 box. So again, if they're working the low, and reversing, our 50 pip box then could again become a measuring tool if the market is to pull away from this lower quarter, trapping volume and then shifting away in the timings. We'll move this pink box out of the way. We get the stop hunt down into the lower quarter for the reversal. So again, just targeting 50s and zeros. The market reversed in London, took out the high of the day for a 50 pip stop hunt, hitting the upper 50 pip box before reversing and stop hunting back into the trend, and then continuing through the 50 pip box for a measured move, targeting potentially 2 times that range for a 100 pip target. Now obviously this week that we're looking at had quite a bit of volatility, but as we come into the current week and we'll look at some other instruments, the emphasis I'm trying to make is that 50s and 00s are the main levels that these pairs will target. Quarter extensions will often become an area for trapping volume. And again, the behavior of price at these levels is what's critical. So we taking each module and then putting it together. No one spoke of the wheel by itself is potentially enough. But again, the numbers are critical because the behavior of price at the time of day, at the high or the low, has significant importance in terms of how it behaves, of whether or not the market could be reaching a peak formation, if it's a breakout pullback continuation, or if we're in the middle of a move, or if we have a market that's just potentially trading in a range-bound market. So again, 50 00s, the market comes down to the 00 level, consolidates and continues its move through the 50 pip box, pulling back for a 25 pip stop hunt into the trend to continue that move down another 50 pips before hitting that quarter extension and working it 3 times before going into consolidation. The market again goes into consolidation. In London, we reverse and it breaks above the 00s again for a 50 pip stop hunt to the high of the day in our US session 12 candle window. So again, 3 levels of rise in 25 pip increments before reversing and taking out the low of the day and dropping down to the lower portion of that 50 pip box before going into consolidation. The market then reverses out of the lower quarter back up to the top of the 00s for breaking upwards and working back down into the lower quarter, and again pulling back inside. So our minimum target would be the 50 pip upper box. The market breaks through that box before pulling back in the US session and working down into the upper quarter of that 50 pip box before pulling back and going into consolidation and breaking above the 50 level in Asia and then reversing. So again, as that market reverses, we're potentially targeting where stops are. So again, when we put all these together, we'll be talking about where the money is. We're talking about the high and the low, the structure, the timings. Today specifically talking about round numbers. The market is penned up in 3 pushes into the 50 level, gone into consolidation, and then pulled back at the beginning of the 12 candle window to hit the high one more time. Goes into consolidation at the 50 level, dropping down, hitting stops in that quarter level again. So again, working the high, working the high, working the high 3 times, stop hunting down low before reversing. So again, as the day evolves, just assessing, is price trapping volume in that lower quarter, or are they trapping it in the upper quarter? Well, this is why timings and behavior are so critical, because we can see the market clearly worked into the high with 3 pushes. And then in the 12 candle window, we talk about that first hour often being the stop, hunt, and the trap. So we have a reversal off the high, an engulfment, pin hammer, and a 3-bar push to the low of the day before we get our inside bar at the end of the first hour. And our equities hour is an open drive candle. So if this market was to continue, it would have broke through the quarter level, pulling back and reversing, or pulling up to the round numbers and rolling over. In this particular case, the market is still inside of the previous US session high and low, and we've worked the high in 3 pushes and then stop hunted down to the low of the day after a strong move up the previous day. So we have the continuation coming off of the quarter level. So again, answering some questions regarding the quarter levels, the main focus I look at is targeting where's my 50 pip box, and are they trapping volume in a upper or lower quarter before they're going to shift the market. And again, this is an example of taking 3 sessions where they trap volume over the bulk of the day, from the previous US session, and eventually when the market does shift, we know that all this volume below the 3150 level is trap volume. They pull away and shift the market. So again, the next day, the market works up into the double zeros. This was a Fed day. Buying off the double zeros up to the quarter before stop hunting down into the lower quarter. And then obviously the Fed breaking both the high and the low of the day. And this market went up through the 50 pip box for a 25 pip stop hunt. So again, an example of where the quarter levels will often be the extended stop hunt. And obviously with the Fed, we can get quite a bit of volatility. But then the market came back down 25 pips below the 50 pip box before pulling back inside. And again, working down into the bottom of that 50 pip box. Working down, and then the Asian market gives us our little W formation off the double zeros. We have an anchor point high from the Fed above in the upper 50 pip box. So the first thing I would be thinking is this potentially could be a 100 pip day. Again, the question of where the money is, if the market works itself back up towards this high and we're above that upper 50 pip box, if it takes out this high, chances are this market will continue and go at least to the double zeros. In this particular case, the market pulled back and then eventually broke through the high, layering on the quarter level before continuing into the upper 25 pip box in our 12 candle US session window for a 50 pip from high to low stop hunt back against the trend in that first hour again. So the stop hunt is against the trend to our redrawn low of the day before pulling back underneath the zeros, stop hunting one more time into the initial break of the equities hour opening drive, and then continuing back above the double zeros. So again, pulling back above the double zeros, taking out the high, I'm thinking a minimum of 50 for our next target. 50 pip boxes, 50s and double zeros. The market works into the 50 level the next day before pulling back and pushing up a third time, dropping down to the lower 50 pip box. Again, the market gives a W formation at the end of the Europe-London 12 candle window, works above the 25 pip quarter level before stop hunting again in that first hour down before reversing for a breakout pullback W formation in our US session 12 candle window. And again, we have money sitting above, just below the quarter level. So my thesis would be this market will target somewhere above in that upper 50 pip box. And again, the market pulls back into consolidation before continuing its drive up. And again, just coming back to double zeros. So if we bring this chart a little closer together, we can look at this from the Fed day and see 100 pips. So if we just target levels of rise again, we have our first 100 pip box. The market broke above that, continued for a second 100 pip box, and then continued for an attempt at our third 100 pip box before finally rolling over and reversing. So we have three levels of rise of 100 pips. Third rise obviously only went 75, but we were in three 100 pip boxes before the market failed. So again, coming back at the beginning of the week, we can see where day one was the Friday, taking out the Fed, the volatility, day one, level one on Friday, level two on Monday, and then level three on Tuesday. And again, we see the one push, two pushes, three pushes into the peak before pulling back and giving us again, head and shoulders, triple top type formation. Some people won't agree, but again, we're looking at our three peaks for our 33 and our level 3 potentially trade. But again, our double zeros then become significant. The next day, the market drops into the quarter level below the double zero box, going into consolidation, working up into the double zeros just as the Asian 12 candle window begins, dropping down, going into consolidation at the quarter, continuing down through the 50 pip marker, and then working back in three pushes. Just prior to the US session, we see a stop hunt trapping volume above the 50 level, pulling back and pinning into 50, and then continuing for a 50 pip move down before pulling back and going into consolidation. So today we look at this market and we see the market has pulled up into 50, gone into consolidation, and dropped down off the numbers. So again, depending on how price behaves, we may be looking at a market that could potentially be trapping volume over the course of a session today in that lower quarter for a reversal back above 50, targeting towards the double zeros. Or we could see this market work back up into the high and potentially layer on top of 50 for a continuation towards the double zeros. Currently, though, we have had a reversal off that level 3. The market, if we just zoom in again, we can see that this move started on Friday. The market has still made new lows, but we've pulled back, and again, we're inside of that 50 pip box. So depending on how price behaves, at this 50 pip level will determine how we proceed from there, whether we move up in 50 pip increments or if we roll over and work our way down towards the bottom of that 00 box. We can look at gold. The same principles apply. The market tends to move in 50 pip increments. And again, just looking at, we talk about structure, high and low of the day, the timings, and obviously round numbers. Now, somebody mentioned to me the other day that the timings haven't really been relevant the last few months. I completely disagree. Timing is everything. These markets move when those 12 candle windows are in place, because that's when the equity markets are trading in that middle hour. And that's when the money around the world is circulating. So yes, there are trades or highs and lows that come into play outside of that 12 candle window, but the market moves in that 12 candle window. And most instruments, pretty much every single instrument, will move in some variations of either 50 pip movements and on some days maybe 100 pip movements, depending on the instrument. We can see on gold, again, the market is in a 25 pip box. It breaks through that lower quarter level for pulling back, dropping down again, stop hunting up, and then rolling over for a 50 pip move down. Our major numbers on gold, again, 50s and 00s, but gold will move off of 25 pip increments. And again, you can put the sweet spots indicator on any chart, obviously depending on the instrument and the numerical breakdown of that instrument. You may need to adjust the indicator for that instrument, but all instruments move off of number levels. We can look at the euro. Same scenario. We can go back to the beginning of the week. We can look at our beginning of the week. We have a consolidation from Friday. The market is above the 00s, trades off it in Asia, consolidates, works down into the low of the day before reversing above the 00s. Again, I have money above the quarter level. I'm thinking a minimum then of this market pulling back inside is to the 50 pip marker, 50 pip boxes. The market pulls back down in consolidation, goes above it again in Asia. I know there's money above the high of Monday. I'm thinking 50 pip marker. The market works up into the upper 50 pip box, doesn't quite get there, pulls back to the quarter level in the Europe-London Open, hits the high one more time. So again, we've got a high of the day in place. There's an example of the market working back to the high, working the high. So somebody asked me, what do you mean? Is it higher highs, higher or lower highs, lower lows, or higher highs if they're working the high? This is an example of where the market does not have to take out the high to be working the high. It comes back and hits the low, goes back in 3 pushes, 1 push, 2 pushes, pulling back, and then a 1, 2, 3, hitting the high of the day, pinning through the 00s, closing below the 00s on a 1, 2, 3. Our high bull gets taken out on the next candle. We're thinking a minimum of 50 pips. The low of the day, if it was to proceed that far, is in the lower quadrant below the 50 marker. So I'm thinking 00s. Now again, timing, how price behaves, all of these factors, depending on how you're trailing these pairs, because the market may come down as it has here and go to the numbers before pulling back. Now, some traders may want to close this before it rolls over. But again, coming back to the numbers, 50 pip boxes. The quarter levels will often be areas for extended stop hunts or trapping volume over the course of 2 to 3 sessions before shifting away and leaving that volume to either be stopped out or to increase their losses. So again, coming off of the high, the market dropped down to the lower quadrant above the 00s before hitting the 00s, working the zeros, 3 pushes into the redrawn high of the day before giving us our pin hammer engulfment at the beginning of the 12 candle window, pulling back just prior to the London Open and then shifting away. So again, an example of where the market worked down to the lower quadrant, and that volume above the double zeros in that upper quarter became trap volume before the market shifted away for 50 pips, and then again pulled back into the quarter, on the American payrolls, ADP non-farm payrolls announcement, working back up into the quarter. So again, saying to yourself, are they trapping volume below the 50 pip box or above the 50 pip box? This market broke through the 50 pip marker. Then again, the thesis would be that the market would continue down through that 50 to the double zeros, but obviously it hit support at that quarter level. And currently, as we trade inside of that quarter, the question then will become, are we trapping volume in this quarter underneath of 50 for a move back up above the 1850 level, or are they working this back into the zeros for a move down through the low of the day? Now currently, again, we have had a high of the day put in place on this pair. We don't yet have a low of the day in place, but depending on how price behaves in this quarter, we could be looking at a move back up towards the above the 1850 to 1900 level, or again, if we bring this chart a little closer and zoom in, ask ourselves where the money is, and could they be working this back up into the double 1850 level for a move back down. So currently we've had one push, two pushes, three pushes into the low before pulling back, consolidating, hitting inside of that low of the day one more time. And again, how price behaves as we head into our next session will determine whether or not we're trapping volume above 25 or below the 1850 level for a move back up. Just looking at the pound yen, another pair. Again, all of these pairs behave similarly, but double zeros and 50s are significant. And again, just focusing on the numbers today, not getting into structure, timings, high and low of the day, just particularly the 50s and double zeros, where we're at in relation to the high and the low, the behavior of price at these levels, and then when a market does return to those levels, if we're looking at a measured move through that next 50 pip increment, or if the market is indeed reversing or trading off of double zeros from 0 to 0. So study the instruments, look at your charts. Again, putting all these pieces together later will make a lot of sense, but 50s and double zeros are significant, and then identifying as a market's trading how it's behaving when it gets to these levels, the timings, the time of day, that gives us a thesis for 25 pip levels of rise or fall, or 50 pip levels of rise or fall, 50, 50, and 50, pulling back for 50, pulling back for 50, consolidating for a potential breakout pullback and a continuation for 50 or 100 pip move. And again, just paying attention to how price behaves when it gets to these levels. So hopefully you got some value from today's video, traders. 50s and double zeros, quarters will often be an area of an extended stop hunt or a bracket for trapping volume before the market shifts away for a 50 pip or more move. Stay disciplined, stay focused. In our next module, we will be looking at engulfments and pin hammers in relation to the highs and lows and the timings and the round numbers, and how price behaves when these show up. Have a great trading session, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined and may the markets go with you.